Jim, what's the weather like for you guys right now?
It's been so cold, in the 20s.
That'd be a heat wave for us.
Yeah. We've had snow on the ground since Thanksgiving. And
oh, wow.
My ski area got 3 feet over the weekend.
Is that too much or perfect or?
I haven't been up there, so I'm going up Thursday for some training. Okay, I have 159.
Yeah, it looks like we've got some people logged in. Thanks for joining us. We'll be starting wait a few minutes after 2 o'clock, just give some people opportunity to get all logged in. So appreciate you joining and look forward to the presentation. While we're waiting, if any of you that are logged in right now, if you could send us a message, type of message, kind of the area that you're from and type of weather, that'd be great. We'll be able to test our system. So if you would do that, appreciate it. Of course, we always have someone from the West Coast where it's sunny and nice. Then I see someone from the East Coast. They have snow like we do here in the Midwest.
It's like they're having lovely weather in Washington, D.C.
Oh, all these 60s. I live in the wrong state at times. I was just speaking with one of our staff members out in Hawaii. So it was sunny and beautiful there.
We'll just give it another minute or two and we'll get started. Let a few more people get logged in. Lots of snow in New York. And I'll be in San Diego for New Year's, so I'm looking forward to that.
Yeah, it was interesting, Jim, when, out at the MJ BizCon last week, beautiful sun, 65, and then come back to Minnesota, got a fresh 3 inches of snow and -6.
Wow. Yeah, we had beautiful weather in Las Vegas last week for MJ BizCon. It was perfect. So
anybody that just joined recently, we're going to probably give it about 1 more minute.
Yep.
And we'll get going. And in the meantime, just testing out our system. Looks like it's working, but if you could let us know where you're from and maybe tell us about the weather, that'd be great. I see someone's proud. They moved out of Minnesota. Very wise move. It's always a nice place to visit in the summer. And
I'll be monitoring the chat every few slides. So if you have questions, go ahead and type them in the chat button, and we'll address them as we go. We'll probably finish up about 45 minutes into it, leaving another 10 or 15 minutes for questions at the end. So I see we're up to 39 participants. The weather is horrible in Connecticut, okay? So, all right, here we go. You got Jim Marty here, founder and CEO of Bridgewest CPAs to the cannabis industry, and my partner here, Corey Parnell, who's our operating officer.
Yeah, again, welcome everyone for the presentation. And if you haven't heard about Bridgewest before, we are a cannabis-only CPA firm providing advisory services to the cannabis industry since 2009. And as Jim mentioned, he is the founder. And Jim, maybe you want to just talk a little bit about your experience in the past 10 years.
Yeah. Well, I've been a CPA in Colorado with my own firm starting in 1984. And in 2009, I was one of the very few CPAs in Colorado to accept cannabis clients. I did some due diligence. I went out to California, met some people who are now my good friends, Hank Levy and Henry Wojtkowski, and they told me, Jim, the IRS wants you to help these people. And that's been my experience. So we've signed hundreds and hundreds of cannabis tax returns, audited financial statements. We've been through about 36 IRS audits, and we learned a lot about IRS Code Section 280E and how to mitigate it, and that's the subject of today's discussion. Next slide, please. So here's what we're going to talk about today. What is the IRS's position on 280E, and how did they get there? Understanding the implications of recent tax court decisions. We'll talk about three major cases that have been handed down by the tax courts in the last year, a couple just this past summer. And management companies got tied up in one of these cases that we'll discuss, and the court decisions related to management companies. And then one new argument that has percolated to the surface, although I thought this should be argued for many years, is the Eighth Amendment regarding excessive fines and penalties, because as Corey can attest, many of our clients find themselves in excess of 100% tax brackets, or even 80, 90% tax brackets. But even worse than that, you can be in excess of 100% tax brackets. Corey?
Nope, I think you kind of covered everything that we're going to be reviewing and discussing today, Jim. I don't have anything to add at this time. Maybe you want to talk about the history of 280E?
Yes, yeah. We'll talk a little bit about C corporations too, because C corporations now have a nice low tax bracket and some ways to exit without paying taxes. So the tax court in 1981 handed the Edmondson case down and found that he was entitled to his deductions. And personally, I think the tax court got it right. Any business is allowed to deduct their deductions, and Mr. Edmondson was a drug dealer, and he wanted to write off his cell phone and business use of home, and he did, and he won in tax court. A year later, the IRS reversed this with an act of Congress, and that'll be on the next slide, I believe. And here is 280E, just a very few words, but there are some real high points in 280E here. No deduction or credit, and that's important that it's not just deductions, but it's credits. We'll talk about that here in just a minute as it relates to hemp. We're going to intermingle this conversation with hemp, because hemp is very interesting. But let me finish this thought first. No deduction or credit shall be allowed for any amount paid or incurred during the tax year in carrying on a trade or business if such a trade or business consists of trafficking in a controlled substance, meaning Schedule 1 and 2, which is prohibited by federal law or the law of any state in which the trade or business is conducted. So unpacking this a little bit as we go back through, right above the word conducted at the end is the word or. And if that had said and instead of or, we wouldn't have any problems here because certainly all of our clients that hold cannabis licenses across the country are compliant with state law or they lose their license. So if that was and instead of or, we'd be in good shape. But it does say or, and that's how the IRS is interpreting it, that 280E does apply to all state licensed cannabis companies, as I'm sure many people on this phone call know. Most recently, hemp was removed from Schedule 1. So 280E no longer applies to hemp companies. Hemp is really fascinating. You can't turn on a radio or a TV without seeing CBD commercials. I was listening to the Broncos-Kansas City game on Sunday in my car, and between each commercial on the radio were CBD commercials. What's very interesting is, marijuana has a long history. It's been legal for 10 years under medical. It goes back to 1996 for medical marijuana in California, and then for many years going back into the 60s and 50s, really back to the 1930s, there was a black market for smokable marijuana. Hemp, on the other hand, is really only 2 or 3 years old, even though it was grown in large quantities throughout until the 1930s, when really almost mistakenly lumped in with marijuana and made illegal, because there's so many products you can make with hemp, from paint to oils to all kinds of things. But in the last 2 years, the hemp companies that have sprung up really don't have the long history that marijuana does. So we have smokable hemp now, we have extracted biomass, we have all kinds of hemp products for pain and sleep. So that's fascinating that hemp is not here. So if you have a hemp company, you don't have to worry about Schedule 1. I'll have to say right away, that has not been tested in an IRS audit, but there have been some publications recently where some very prominent attorneys are taking the position that hemp no longer has to worry about 280E. And then moving back up this slide, no deduction or credit. Well, that's where the hemp industry comes back in, because if you're a farmer, and a lot of hemp is grown outside, you might want to take a credit for the off-road fuel tax credit, because if you're not using your fuel to drive on the roads, farmers are entitled for the fuel they use in their fields not to pay the fuel tax. So you get a fuel tax credit. So now hemp companies should definitely apply for the fuel tax credit and probably the R&D credit too. But for marijuana companies above 3%, then no deduction or credit. So you can see how hemp is really blurring the lines. As we just mentioned, Corey and I were in Las Vegas last week, and one of my big takeaways is because hemp is no longer on Schedule 1, you're really starting to see some big business coming in. Big air conditioners companies, big thermostat companies are coming in a big way to supply products to the hemp industry that they wouldn't have felt comfortable supplying to the marijuana company. I think, Corey, do you have any comments before we go to the next slide?
Yeah, just one, Jim. And it comes back to 280E. Not only is it applicable on the federal level, however, majority of states start with federal taxable income, and unless the state statute allows you to take the 280E deductions on the return, on the state return, you end up in a bad situation. There are some states that I think there's 10 states that do allow, where they modified the state statute to allow you to take the 280E deduction. Here in Minnesota, where I'm based out of, we actually testified in front of the House and Senate 2 years in a row to get that, where they would modify the state statute to allow the operators here in Minnesota to take the non-deductible expenses under 280E as a deduction. And we're working in other states with our clients, legislators, to get that corrected as well. So at that juncture, Jim, maybe we'll go to the next slide with the next case.
Yes, because Colorado does allow the deductions. I believe the California rule is that you get your deduction unless you've been convicted of a crime. So there's two big cannabis states that do allow the deductions. So the takeaway for the people on this webinar is to be sure to check your state rules and see if you can take deductions that are disallowed at the federal level. Now, the CHAMP case, which stands for Californians Helping to Alleviate Medical Problems, that goes back to 2007, I believe. Very landmark case. Initially, the IRS wanted to deny cost of goods sold as well as other deductions under 280E. The taxpayer, CHAMP, prevailed in that argument and said, no, our Constitution allows cost of goods sold. Taxable income is defined as sales less cost of goods sold. Unfortunately for the marijuana industry, the current IRS position is that all other deductions outside of cost of goods sold are at the discretion of Congress, and Congress has denied those deductions under 280E. So although we have fought that and fought the good fight early in Colorado here, the IRS has prevailed so far in tax court. The other takeaway from CHAMP is that you can separate your business. So I just got a note from somebody on California. Let me see if I can find that. California only allows deductions at the state level if the operator is taxed as a corporation. Okay, very good. Thank you for that clarification. And I think also that the taxpayer can't have been convicted of a federal crime to get those deductions, was the way I understood it, but it only applies to corporations. And most California operations started out as corporations because California had a not-for-profit model for many years. So thank you very much. That was from Michael. Going back to my slide here, you can separate out your businesses that are not cannabis related. Our real-world experience in that in Colorado, if you want that to hold up, say that half of your square footage is a coffee shop or a shop that sells hats and T-shirts and maybe pipes and papers. If you want to deduct that square footage of your rent, if you want to deduct that labor, it really should be a separate company because we have lost at the audit level when 98% of the revenue comes from cannabis, 2% comes from hats and T-shirts, and the IRS has said, no, it's so small that we're not going to allow an allocation of 50% of the rent or 50% of the labor. So if you want to deduct your square footage for rent and labor for non-cannabis products, I say separate, separate, separate. Separate cash register, separate company, separate checking account, and separate tax return. Corey, do you have any comments on that?
No, again, I think the practical side is, whether it makes sense to try to separate it out. And a lot of times in conversation with the client, it's the non-cannabis sales might be about 3% of overall sales if they're doing, let's just say, 100 to 250,000 or a month in revenue.
Yep. So, here we go. Now, Harborside finally got handed down late in 2018. We were all waiting anxiously because they had good legal counsel. They were making very good arguments. But once again, they lost. So even if the holding was that even though Harborside operates at the state level and is compliant with state law, it's still federally illegal and subject to 280E. Also, we're not able to use 263A, although there have been some recent arguments that you can, but for the most part, 263A, and that's where you can allocate some of your general and administrative expenses to inventory, and then inventory always ends up in cost of goods sold when it's sold. That was a way to get some expenses up in the cost of goods sold. That was turned down. However, the good news for Harborside is, I think it was in the millions of dollars of penalties were waived. The tax court judge waived the penalties. And on the first two issues, I believe those are still under appeal. Corey?
Yeah, that's my understanding, is that they did go back and they're appealing those first two items. That is correct.
All right, so now we're going to talk about management companies. There may be a lot of good reasons to have a management company, but avoiding 280E is not one of them. And this course from this past summer, Alternative Healthcare Advocates, was using a management company, the management company charged a fee to the dispensary. The dispensary, when it paid that fee, categorized that expense as a cost of goods sold. And then the management company, of course, would pick that up as income and take all of its legitimate expenses. This was a real disaster for this taxpayer because the IRS not only denied the deduction for the management service fee as part of cost of goods sold, it also applied 280E then to the management company and said that they were close enough to the cannabis company and related enough that they applied 280E to the management company. Another big trap for the unwary, and I get this all the time because cannabis companies have a hard time getting and maintaining checking accounts. And so a lot of times a cannabis company will form their management company so they get a checking account. It doesn't have anything to do with federal law or IRS rules and regulations, but it can really cross you up with your state regulators. And I was involved in a case a number of years ago in Colorado where the cannabis company lost its license because it was depositing marijuana receipts into a management company. And at that time, Colorado did not allow out-of-state ownership, and the management company had out-of-state ownership. And so that cannabis company lost its license because of a management company. So management companies can cause more problems than they can solve. As I said, especially if you're in a not-for-profit situation, there can be a legitimate use for a management company. But be very careful and don't use the management company to get a checking account because, again, you have marijuana licensed sales going into an unlicensed entity. And as I said, we've seen people lose their license for that. So tread lightly with your management company. Next slide. Corey, unless you have any more comments on management companies.
No, I think just overall, one of the things that we spend a lot of time is organizational structure and what we bump into the marketplace in regards of just setting up a management company to avoid 280E or other entities to avoid 280E. And our approach always has been and will continue to be is to really understand what the strategic reasons a company might have a separate entity or multiple entities. So, for example, we have a client that they do have a management company that provides services to their licensed operations, but they're taking that team and they are going into other states to offer those services as well. So that makes good business logic why you would form another organization because that pool of talent is serving multiple purposes versus just trying to move something out of one licensed operation to a non-licensed operation and then avoiding 280E by moving all your G&A expenses up into the management company. So again, when you're approaching this, always make sure that you have management, ownership, legal, and then accounting to understand the strategic reason you're doing something as well as how does this fit legally and then from a tax perspective. So right. Jim, we'll move on that. We'll move on to the next.
Well, one more case on alternative healthcare too is following up what Corey is saying. Yes, it helps a lot if that management company has more clients than one management company. And also, if the management company has the exact same ownership and its only customer is the one dispensary that pays it, that's setting yourself up for the IRS to blow away the management company. So if you are going to have a management company, as Corey just said, try to have more customers than just your one company and try not to have the exact same ownership as the cannabis company. So here's another case. Now this is a interesting case. The Northern Colorado Small Systems, Inc., they made Eighth Amendment arguments we're going to talk about. As I said, I guess I should say right now that the good news is that Bridge West has many clients who are profitable after 280E. So it can be done. you really have to minimize your costs, and we'll talk about that in a minute. But this case had a dissent, and dissents are very important because what starts out as a dissent in one case, so even though Northern California lost on this, one of the judges said, hey, wait a minute, how can you have taxable income when you had a loss? I actually explained this to a tax court judge one time when I was on the witness stand on one of the early cases in Colorado, the Feinberg case, which is very easy to find. I believe it's Feinberg, Feinberg. So say you have a loss of $50,000. If you were in any other business, you would not pay any taxes because you had a loss. I think I just saw on the news that several big corporations like Amazon did not pay any federal income taxes. Well, it's because they're able to harvest tax losses, legitimately not pay any income taxes. In the cannabis business, under 280E, if it applies to you, in a year you have a loss of $50,000 and you have to add back, say, $150,000 of non-deductible retail dispensary expenses, now you're going to pay tax on $200,000 in a year where you had a loss. That seems to be an excessive fine or penalty under the Eighth Amendment to the Constitution. And one of the judges made that argument. A second judge agreed with him, but it wasn't enough to carry the day on this panel of judges in the Northern California case. So that's something to be aware of that I think we'll see, and maybe in the Harborside appeal we'll see this Eighth Amendment arguments percolating to the surface. Corey?
Yeah, just kind of moving on then, what does this mean for your cannabis business then? So 280E really prevents you from directly being involved in selling cannabis from receiving the standard deductions that other normal businesses would get. But it does allow the producers, manufacturers, processors, retailers to deduct what cost of goods sold. And so then the question is, well, what is cost of goods sold?
Right. And that last bullet point, processors and manufacturers do not have the same headaches under 280E as retailers. I always call them the big three. Retail rent, retail labor, and advertising are not deductible to a retailer. Now, manufacturers and processors, probably 80-90% of their costs relate to producing the product. They have some SG&A, they have some legal and accounting deductions, but their rent and labor is pretty much all deductible because it's going into cost of goods sold as part of the production process. So retailers, it's somewhat counterintuitive, and this is where we consult with our clients pretty much on a daily basis to try to get them to be profitable at the retail level. Is I say, if you want to be profitable after 280E, you've got to purchase or grow cannabis and sell cannabis, and that's it. No frills, no trips to Vegas, no having your friends and family on the payroll. You have to keep it lean and mean. And you would think, okay, I want to load up my cost of goods sold because that's deductible. Actually, our most profitable clients have a very large gross profit. You have to have enough gross profit margin to pay your taxes on that margin, pay your retail expenses, and still have something left over. So we have a client that does close to $20 million. They have 2 retail shops that they run for about $600,000. So on $20 million of revenue, and they grow, so they get all their grow deductions, and then they have a couple of dispensaries with low rent, and they keep their payroll costs very low. They don't advertise. They sell everything they grow without advertising, and 280 doesn't lay a finger on them. So that is a model that we'd be happy to consult with people, after this phone call on exactly how do you do that, and how do you keep your retail, and what should your profit margin be in order to be profitable. And like I said, it's counterintuitive. People think you load up cost of goods sold when it's the exact opposite. You need to have enough margin to allow you to pay those taxes and your retail expenses and still have money left over. Corey, you want to take this one on the inventory cost of goods sold?
Yep, but again, the not getting into particular code sections, but really under 471, and as Jim mentioned, really for the cultivators and processors, this is very helpful. If you use GAAP, you can actually include more inventoriable costs. So, and then the proper allocation of costs related to inventory should be done by line. And what I mean by that is our particular process that we go through, we look line by line and then say, is this cost related to the production of inventory? And to be honest, a lot of times we find where there's line items that, let's say in a traditional manufacturing client, we wouldn't even bother moving an expense from non-inventory or non-manufacturing cost up into manufacturing cost, because that way it doesn't get absorbed into inventory, but we get it as a period expense. But that is not the case in this industry, is because anything that's not included in inventoriable cost is non-deductible and therefore lost forever. And again, even proper allocation of payroll and related costs, a common thing that we find out, especially as operations are first starting out, are the CEO, the COO, even the CFO, that they're involved in some way in the production of the goods. So looking at the payroll and the related costs of those people and making sure that you're identifying, supporting, documenting, when and if you're audited, that you remember 3 years ago, why did we put Joe 50% of his salary or guaranteed draw as cost of goods sold? And then, again, another payroll software that we will recommend is Work Payroll versus a national payroll company. But they've done their cannabis-only payroll human resource package. But again, what they'll do is your people, your staff, or yourself, you guys can actually log in and out of doing work. So, for example, if you're running a retail or dispensary and the person's leaving the sales floor, going in the back room and going to assemble some finished goods, they would actually log out of being sales and into working on finished goods, and that payroll would be deductible. And again, looking at indirect overhead costs allocated to the product, line by line. Insurance. Are there components of insurance that really relate to the production of goods? And a lot of times, again, we're seeing it's below the line, not being included as part of cost of goods sold. Apply Champ in the olive case. That's where Jim was mentioning that if you have non-cannabis piece, to actually break that out, have it as standalone business, and the bottom line is it has to make money. Otherwise, it could fall into what's called a hobby loss. And if I remember, Jim, you have to make profit 2 out of 5 years in order to not be considered a hobby loss.
Yep. And, I mean, you can argue exceptions to that, but that's the general rule.
Correct. So then, again, inventory costing, we see a lot of different methodologies, but again, allocating into the different departments and where that falls, especially if you're vertical. Something not being touched on here is at the retail or dispensary. One thing is looking at your floor plan. And one of the key things that we keep telling our clients, we've got one client out on the East Coast. They do about $1 million, $1.2 million a month out of 1,800 square feet. You don't need 4,000, 6,000 square feet to really operate, because that's a lot of product you have to sell to cover that additional square footage, as well as the additional labor, and then your investment that you put into that retail is significantly higher because it's a bigger footprint. So your ROI just gets crushed by having bigger is not better in this particular case.
Yes, you can sell a lot of cannabis out of 1,000 square feet. You know, up in Massachusetts, and we visited some of the dispensaries. We have clients up there, and you know, it's not uncommon for them to have a line around the block because it's a small dispensary, doesn't have a big waiting room or anything like that. And the patients and customers, they wait for that line around the block to get their cannabis and go home. A couple of comments I have on this. Go ahead, Corey.
Oh, I was just going to mention, even with the use of technology, even though they're in a line, and right now the lines are created because of a shortage, but, you know, they're buying on the app, so when they're actually walking into the store, especially if they're already educated on the product, they're actually just going in to pick up their purchase. So, again, technology really can help with the operations of the retail or dispensary.
Yes. So the comments I have on this slide are, as Corey mentioned, line by line, think about every expense, and not only an expense to put into cost of goods sold, but think about every expense. Do you really need it? Can you eliminate it? You know, buy marijuana and sell marijuana. Keep that in mind. On the labor, packaging is deductible, packaging labor. So it's kind of ironic, but some of the small victories we've had at the IRS audit level is rolling joints. That labor is deductible. That's part of production. In Nevada, if you have a production license, you can roll marijuana joints by the hundreds and thousands and sell those to dispensaries. So that labor is all deductible. Keep really good track of your labor. That's why we do put a plug in here for our no relation to Bridge West, but we work closely with Work because they have a great program that allows the employee to tap a code on the computer screen and shift from a non-deductible face-to-face meeting with a client into a deductible, hey, I'm in the back room now rolling joints. So that keeping really good track of your labor is important. Now, a loss that we've had at the audit level is, well, people say, I talked to the medical patient for 10 or 15 minutes, then I sold them the product in 2 minutes, therefore only 2 minutes of my time is not deductible. The IRS has shot that down, and consultation with patients or customers is considered part of non-deductible labor at this time. I think we can move on to the next one. I see we're coming to the end of our time slot. Another 5 or so minutes, or maybe 10 minutes, and we'll put it over to the some questions and answers.
Yeah. So on this slide are just some general observations that we're seeing or we heard regarding the IRS. And then I don't know, many of you might have saw, and there was an article in the Marijuana Business Daily, October 16th. That a former IRS attorney warns of upcoming tsunami of marijuana-related 280E audits. And in conversation with that particular attorney when we're in Vegas, he was just saying that they'll continue to audit this area because they do want enforcement. I'm going to skip down a couple. One is IRS field auditors. They're no longer general field agents. They're back to specialty teams, and therefore it's kind of our understanding is this program, their audit program, has been developed on their experience from California and Colorado, and that will be applied in other states. And then the last item at the bottom is the IRS is no longer the opinion 280E is applied once. They believe the dollar moves up with the chain. Again, that's where if you're moving money to a management company, we're talking with another an attorney that handles 280E audit cases. And in conversation with him, he was dealing with a license holder that leases from another organization that has no common ownership, but that organization that was leasing the real estate, the equipment, they provided a working capital and some management services. The IRS is now attacking that unrelated entity, saying that they are subject to 280E. Don't know where it's going to go or end up, but again, we're seeing that the IRS is reaching beyond just the license holder. Jim?
Yeah, a few comments on this slide. That first bullet point about the 280E, you really can't play audit roulette, take all your deductions and hope you won't get audited, because in most states, the holders of marijuana licenses is public information. It certainly is here in Colorado. And the IRS then has that list, and what they do is they know who the marijuana license holders are, and they, as soon as the tax return comes in, they look for it, they survey it, that's the IRS term, they survey the tax return and look and see how 280E is being handled, and then decide whether or not to audit that. And if the IRS doesn't get you, then the state will, and your local sales tax people will. The state and local governments are very interested that the correct sales tax is being charged, not just to customers, but also if you're buying product to grow for your cultivation. Some products are considered part of the manufacturing process. Others are considered operating expenses. If it's part of the manufacturing process, you don't owe sales tax on the nutrients. If the local government thinks that your nutrients are actually a supply, then you owe sales tax on those. The state and local sales tax and use taxes are very complicated. If you're buying things off the internet and not paying sales tax, you should have a discussion with your accountant on whether you're creating a liability for yourself. Another area that is of big interest is we don't like to use rental companies. Somebody says, I'm going to set up a separate company to hold all the lights. I'm going to rent those to my marijuana company. Well, it's just like when you go and buy or rent a tool for the weekend at the tool shop to do a home project. When you rent that jackhammer or whatever you're renting, you pay sales tax on that, right? When you rent a tool for the weekend, same thing with your lights. If they're in a separate company and you're renting them to the operating company that's growing, you might be creating a separate liability for unpaid sales taxes. So we don't really like to use management companies, equipment leasing companies. What else on the screen? The field auditors are specialists now, and this all started back in Feinberg, where the IRS attorney in Denver wrote a letter to Washington, D.C. and said, hey, what do we do here with marijuana? And they wrote back and they said, because 263A allocating overhead to inventory and cost of goods sold was not around when 280E came into play, you're back under 471. And so IRS Code Section 471 is where we go to see what we can put into cost of goods sold and what we call an inventoriable cost. So those are my comments on this screen. I'm going to try to move things along so we have some time for questions and answers.
Yeah, Jim, I don't think we need to spend much time on this. No. It's just a snapshot of your legal business and then what is considered illegal business. And as you can see, the line selling general and administrative is disallowed for 280E. And if everyone can imagine, if Walmart or Target, large retailers, if they had to pay income tax on their gross profit and not allowed to deduct any of their selling general and administrative expenses, none of the retail people rent or retail space, utilities for retail and so forth, they'd be extremely challenged to show a profit. And I think that,
and here's the same thing, numerical. Yeah.
Yep.
This is the tale of two. I call this can we go back for a sec?
Yep. Sorry.
I call this the tale of two businesses. Showing this one, they're able to have a gross profit of 40%. With their SG&A, they're able to have a profit after taxes of $900,000. The company on the right, their margin is only 35%. They've got an extra $1 million of overhead, so they're going to have pay tax on the $3.5 million. That's the $1.4 million. So they are actually in excess of 100% tax bracket. Once again, showing the dramatic impact of just a few changes to your overhead and a few changes to your gross profit can have. And this is the kind of consulting that we do here at Bridge West to help people get into that left-hand column and stay out of that right-hand column.
And then, do C corporations make sense for you, Jim? You want to cover this?
Yes. Sure. C corporations have some distinct advantages, mostly because of the 2018 Jobs Tax Act that lowered the tax rate to 21%. Owners of C corps are generally not personally liable. That's a big deal. And we have clients who unfortunately personally owe over $1 million in taxes. And normally a person can get rid of unpaid income taxes after 3 years. If the IRS can't collect in 3 years, you can file personal bankruptcy and get rid of those taxes. There's some debate on whether that route is available to owners of cannabis businesses. So we like C corps because you're not personally liable. Couple this with the 21% tax bracket, especially for retailers. If your production, if your extraction is maybe not so critical, the reason people have stayed away from C corporations in the past is on exit, C corporations have a higher tax. However, there are some provisions in the new Tax Act. If you're in an opportunity zone, that's a question that everybody should ask when you're looking at your real estate. Are you in an opportunity zone? We generally set things up as RepCo and OpCo, the real estate company and the operating company. So when you're looking at real estate, if you're going to build a building to cultivate, if you're going to build greenhouses, see if it's in an opportunity zone. And if you hold that stock in the company that's in an opportunity zone for 7 years, you can get rid of a lot of the taxes on sale of that business. And after 10 years, have actually zero taxes. So let's see what else I want to say here. Anyway, that's why we like C corps.
But again, that's where we always have a conversation with management, legal, and accounting on the entity, the structure. So, Jim, we've got some questions. Do you want to?
We do.
Take the first one from Mike.
Yep.
The
Marshall
first one, are you at? Oh, go ahead.
Well, the first one I see is that relating back to the state deductions being allowed. 2020 returns flow-throughs no longer have to apply 280E. Marshall says he's from Vincent's in Colorado. I think he's talking about California because flow-throughs, which would be partnerships and S-corps, and I'll let Corey talk about S-corps, 280 definitely applies to partnerships at the federal level. In other words, you're still not allowed your deductions on a partnership at the federal level, but in Colorado you do get to take those deductions. Corey, you want to say something about S-corps?
Yeah, again, generally we advise against S corporations versus if it's a limited liability company and or a C corporation. There's just many caveats around the S corporation, lack of flexibility that you have in an LLC versus an S corporation, as well as the salary requirement within the S corporation as well.
Okay.
And then
some other good questions.
Jim,
go ahead, Corey.
I was going to say, Mike's got a question.
Are we at risk? We don't think so. Bridge West, we do not own any part of a marijuana business, so we don't consider ourselves a touch the plant company, and we have not had any issues with that as of yet. But that is a concern that 280 could be a risk for companies, but we're very careful about not being a touch the plant company. And up till now, the IRS has really only applied 280E to touch the plant companies, or in the case of the alternative health that we saw, that where they just basically considered the management company to be part of the cannabis company.
Right.
Charles has a question. What are your thoughts on minimizing
Go ahead, Jim.
Minimizing the impact a company that is both growing, manufacturing, distribution, and retail? You want to grow for a very low price and get a large price. There's huge margins right now in states like Massachusetts and very small margins in states with overproduction like Oregon. So it varies greatly from state to state. But you really have to understand your costs. If you don't know what your costs are, you will pretty soon as the bills come in. So we do a lot of consulting on on cost accounting. That is Corey's area more than mine. On accelerated depreciation, the IRS has not allowed us to do 169 or 179 and bonus depreciation because those were not around in 1982. So you're back under the most accelerated depreciation that the IRS allows under audits is double declining balance, which is basically makers. Corey?
Yeah, a couple things. One is, again, there you can minimize, especially if you're, I'll call it a vertical, grower, manufacturer, distribution, retail, just segregation of costs by the different activities and make sure that you're onboarding it related to either growing the plant, the manufacturing of either your oil or flour, distribution as well, identifying the costs, distributions, another tricky area, what are the costs that you can and can't deduct in relationship to that delivery of the product, and then we kind of touched on the retail. And in regards of, accelerated depreciation, bonus depreciation, we haven't seen anything. I know I saw there was an article put out by Henry Wojtkowski's office that they're making an argument, I can't remember, I think it's in front of the 8th District regarding the recovery of capital, which ties directly to depreciation, but I know that's still in court, and I'm not sure. When I spoke to them last, they're hopeful that they might hear something by mid to late summer.
We have a question here from Illinois, Scott, about Illinois. Illinois is going to be a great state. You're going to have such a shortage of cannabis that your margin should be very large. I think you'll look a lot like Massachusetts with, maybe you're growing a pound for $700 or $800 and selling an eighth for $60 or $70. You're going to have plenty of margin in Illinois. So Scott's concerned that they might be doomed because of the community benefits. Some people, there's a lot of social justice initiatives in Illinois they're talking about for people who have been adversely affected by the war on drugs. You should have enough margin to be able to cover those, but that's really what to focus on, Scott, is try to grow or purchase your cannabis for a low price, and then make sure you have a good, healthy margin that we'd be happy to consult with you on at another time.
And again, we've kind of seen that. I was going to touch on that real quick. The other place we've seen that, again, is in Massachusetts, kind of same thing. They've got their hosting tax. We've seen it where the dispensary or the vertical in this particular case, they committed to buying a fire engine for the community as well as some other ancillary things. But again, just making sure that you look at the market and properly model in regards of what do we think our operating costs are going to be. A large dispensary, again, is bigger is not better. And then just really managing your costs. You're not doomed to losses if you properly plan it. And especially, Jim did mention that in some of these markets where there's a lack of supply today, that you can get significant margin. But again, when we work with clients, just looking at the history of markets as the supply continues to catch up, and in some cases, Colorado, Oregon, Washington, where the supply actually exceeds demand, that you have to manage your expenses based on the fact that there will be price pressures at some point, might be 2 years, 3 years from now, but you're managing your business in relationship to that.
One quick one on the testing labs before we get to another question that's a little more complicated. We consider testing labs to be not touch the plant companies, and 280 does not apply, although I don't believe we've tested that in an audit situation, have we, Corey?
No, in fact, I had a conversation about 3 months ago on that particular issue, an attorney out of California and an attorney out of Colorado, and none of them have seen anything, any audits on the testing lab, and they don't anticipate seeing anything in relationship to that. So there's no cases to support that they will or won't, but again, they're really not part of the transaction of selling the product.
Yes. And then at the bottom, cost seg studies, yes. You should definitely do cost seg studies on your build-out to try to get to shorten up those lives if you're building a building from scratch or retrofitting a 100,000 square foot building. Definitely do cost seg studies. And then we have a little more complicated question up here. It might be beyond the scope of this phone call. Do you see any issues for a license holding LLC that is entirely owned by a C Corp? Corey, what do you think about that one?
Do you see any issues for a license holding LLC that? Oh, no. I've seen it in the marketplace because, for example, where the C corporation, because the investor group will not invest in a flow-through or LLC, they require it to be a C corporation. But what we'll do is have the LLC underneath be the license holder or operating company, and in a lot of cases be a disregarded entity.
Good. Let's go to the next slide and see what we have left. I think we're coming to the end of our time slot here. Okay. Yep, Form 8300. If anybody hands you $10,001 or higher, be sure to file a Form 8300. Last week I gave a talk in Las Vegas to one of my favorite groups, the Las Vegas Medical Marijuana Association, probably about 60 people at lunch at Lowry's restaurant in Las Vegas. And I said, hey, a show of hands, how many of you know about Form 8300? And not that many hands went up. I said, boy, I wish I saw more hands go up, because the penalty for not filing at 8300 can be as much as $25,000 per incident. And we always say better late than never. So if you have realized that you should have been filing Forms 8300 and you have not been, then go ahead and file them and get them filed with the IRS. We haven't seen the IRS come back with penalties when companies self-report, and we have done a lot of self-reporting with our clients. Corey? Yeah,
Jim. In fact, I was talking to one of our associates out on the West Coast, and this probably was about 9 months ago, but the client that he was working with was looking to sell, and they were under LOI, and that's one of the things that popped out right away is the fact that they had not been filing the Form 8300s. So they went back, and the company went back, and I think they completed over 100 Form 8300s and filed them just so that they can potentially sell their license or operations. And to date, that particular client has not heard any repercussions for doing that.
Yeah, and that's been our experience over here in Colorado, too. Somebody had asked a question about protective claims. Yes, we definitely do protective claims, and keep that statute of limitations open. Should we get a victory on 280, should it be held to be unconstitutional or in violation of the Eighth Amendment, then the 3-year statute of limitations stays open just for that one 280E issue, and you can start applying for refunds. So yes, we do protective claims here at Bridge West.
And the other one with the change of the tax law, cash basis with inventory, we've seen IRS, basically where they've come in and they've even assessed or mandatorily made inventory calculations. So that's currently, that's still an open question mark for us, and there's no conclusion in regards of what the IRS's position will be if let's say, for example, your revenue is under 25 million and you want to do cash basis. However, in applying for 71, you have to have inventory. So it's somewhat still of a question mark in the
Yes.
cannabis area.
Yeah, we're not quite sure how some of the agricultural provisions of the Jobs Act from last year affect cannabis, and we are looking into some of those to see if we can be a little more aggressive with not handling inventory. Farmers aren't required to have inventory. Does that apply to a hemp or a marijuana company? Can we lock in some overhead costs into inventory or cost of goods sold? So there's still a lot of unknowns here in the cannabis industry. As we said at the beginning, Bridge West has been involved in this industry for 10 years, and we still have a lot of unanswered questions. And unfortunately, the only way to solve these questions is if one of our clients get audited and the IRS doesn't agree with the position we've taken, and then the issue rises to the tax court level, that's how these things get resolved, and it takes years and years and years. I think Harborside was close to 10 years since their audit started to where they got their ruling last December. Are there any more slides left, Corey?
No, Jim, that's the end of it.
But the last one has our contact information.
Our contact information.
Yep. So please feel free to call us. We're happy to consult with CPAs and lawyers from around the country for your clients if you're a direct cannabis business and you have a local CPA. There's things that maybe we'd be comfortable doing, like an audited financial statement that your local CPA may not want to do, or a business valuation. We also do a lot of due diligence for mergers and acquisitions. What else do we do, Corey, that I'm not mentioning?
Yeah, we do outsourced accounting. It's one of our fastest growing areas. And the benefit of doing that is, again, there's no real legacy accountants out there. So our staff is familiar with the industry, recording transactions, working with our tax people to minimize 280E. And the service is a la carte. You could start today if you end up finding an accountant that you want to do the books. We'll transition. But that's actually an area that it's probably our fastest growing area and provides great service. And it's an a la carte that starts at the lower volume might be $500 a month to our largest client that we do work for is about $7,000 a month. That's a vertical with 4 dispensaries.
All right. Well, we're going to close this out. I want to just share one final thought, a takeaway from this webinar, and thank you everybody for attending. The takeaway is that you can be profitable in spite of 280E, but you have to do everything exactly right. So with that in mind, we're going to go ahead and sign off. Thank you, everybody.
Hey guys, still there?